right, hello everybody. Welcome to today's webinar, 3 Techniques to Help You Capture Trades of a Lifetime. I'm Jerry D'Ambrosio. Hope everybody's doing well today. I do want to thank you guys for taking time out of your day. You could be doing a lot of other things, I'm sure, but you're here with me today. You want to become better traders, and I love that. I really appreciate you guys taking time out of your day. My name is Jerry D'Ambrosio. I'm the Manager of Educational Content with VectorVest. I've been with VectorVest now going on almost 15 years. And I am just one part of our education team. Our job and our goal is, again, to make sure you understand the VectorVest program, but just become successful in the stock market on a consistent basis. And my promise to you is this: by learning what I'll show you here today, you'll see how you can use technical indicators to help anticipate what is likely to happen in the future. And one of the main things I want you to take away from today's webinar is speed is the key. The speed at which you find your trades and react. Okay? I would like you guys to stick with me to the end. If you do stick with me to the end, I will share with you a copy of today's slides. Just somebody remind me at the end, say, hey Jerry, don't forget, put the slides in the chat box, and I'll go ahead and do that. And make sure you guys all have a copy of today's slides if you stick with me to the end. Okay? I've worked with a lot of traders over the years, and some of them, they let me know some of the problems that they have when it comes to finding trades and just using technical indicators in general for trading. They feel like it's a crapshoot. Markets go up, markets go down, but they just feel like using technical analysis is a little riskier than what they're used to. They are trying to jump into this trader's game, right? Shorter term swing trading. They're used to buying and holding and using fundamental analysis to help with decision making. This is a different game. You're shorter term. You're only likely to hold on to a stock for a few days, a few weeks. So they really feel like they have to get direction right. They have to be right on the stock price, or it's just going to be a crapshoot. They also don't have the knowledge when it comes to trading. They feel like they don't know everything, so they just avoid it. They say that there are too many indicators with all these funky names, so they just say, you know what, I'm going to stick with what I do best, what I know, and that's, again, fundamental valuation, buy and hold for a little bit more longer term than just a few days, maybe a few weeks. Plus, when they do decide to do it, they're going through hundreds and hundreds of charts every single day just to find maybe a handful of candidates for that day. You can imagine, you keep doing that for too long, you're going to get frustrated, and you'll give up. Now, I'm not saying you'll give up investing completely, but you might not want to play this game too much longer. You don't want to trade or worry about technical indicators and changes in short-term trends and in situations where price is exiting out of a really oversold level. All of these pieces of analysis and situations are what traders look for to help pinpoint entries and exits. Okay, because again, your holding period is very short-lived. So what we want to do is we want to put the probability on our side. Okay, you don't want it to be a crapshoot anymore. You want to know what you're doing. Look, if you're just starting out trading, you're not going to know everything when it comes to every indicator in the book. Okay, but you will know exactly what you need to know to be successful. Plus, you want to be able to find your trades quickly, as opposed to looking at graph after graph after graph. I don't mind looking at charts. I really love looking at charts, actually. But I like to get to the chart a little quicker. And there are different ways to do that. Okay? The first thing you need to understand is when to use certain indicators. Now, there are 3 types of market situations that we're going to talk about today. So the market can do, a few different things. It can trend, okay? And in that type of environment, there is a certain indicator that I'll talk about here today that we will focus on. Okay, so the market can do one of three things. The first, and this is all a type of market that we enjoy, right? It's a trending market where we've been in a trending market for quite some time. Investors love this type of market. Traders love this type of market. Everybody likes a nice uptrending market. Then there are situations where the market no longer trends. It channels, it moves sideways, otherwise known as a trader's market. Investors don't like this type of market. Traders welcome it, but an investor whose holding period is a little bit longer in a sideways market, you can just imagine what the average stock is doing, right? It's moving sideways. Investors don't make a ton, if any money, if not any money, in a sideways moving market. Then there are situations like we saw in March of 2020. We saw it in December of 2018. There are situations where the market hits an extremely oversold situation. And we're going to talk about an indicator to use for each of the three types of market situations that we see here. First, though, you have to recognize what the market's doing, how to recognize a trending market. Here we're looking at the VectorVest composite. This is from February of 17 to February of 18. Don't worry about the time frame that we're looking at here. It's kind of the technique and the observation of what the market's doing that's important. This is a trending market. Okay, this is a trending market. This is a market that hits higher highs and higher lows on a consistent basis. Our job as traders is we want to focus on being bullish only in an uptrending market. And we want to be neutral or defensive during market pullbacks within an underlying uptrend. So being bullish only means we're only going to buy stocks. We're not going to short stocks or buy contra ETFs during these market pullbacks within an underlying uptrend. We're going to buy stocks on dips. We're going to add to our positions during rallies. And we are going to become defensive. We're going to tighten up our stop criteria after each subsequent higher high. Take profits. Okay, free up some cash for the next buying opportunity. Okay, so again, in an uptrending market, we want to be bullish only and defensive or neutral during market pullbacks. Okay, now that was basically all of 2017. Now we're headed into 2018. Okay, and as you can see here, this is from January of 18 to August of 18. As you can see here, the market's no longer trending. It's channeling. It's a rather wide channel, but it is channeling. How do I know it's not trending anymore? Well, the market's not hitting higher highs anymore, but it's also not hitting lower lows either. Okay? In other words, it's just bouncing up and down, back and forth between a support and a resistance level. Investors do not like this type of market. Imagine buying a stock at the beginning of 2018 and holding it for 8 months and likely not making much money. You will make money, then you'll give it back. You'll make some, you'll give it back. You make some, but all in all, the average is just moving sideways. Traders, again, welcome this type of market. I love this type of market. I'll play bounces off support. I'll play retracements off of resistance. Go both ways. So this is really important to recognize what the market's doing. And I'll show you in a moment why it's so important to recognize what the market's doing. Now we're looking at a situation here where December of 2018. All right, so we've transitioned from 2017 to 2018. 2017 was a nice trending market. Beginning of 2018, for the most part, for a good 9 months or so, was channeling, was trading sideways. Then we get this downtrend at the big end of 2018, and the market got crushed, right? New low at the end of December of 2018. And this is when the market hit an extremely oversold situation. Now I'm looking at the market and I say, yeah, that's a pretty oversold situation. The market the VVC goes from about $49 to below $40 in a span of about 4 months or so. So yeah, really oversold market, but it's not price that I'm looking at. It's the two indicators that you see there at the bottom. Um, Within the VectorVest program, we have two market timing or market analysis indicators that help us identify really oversold market situations. Those are the MTI and the buy to sell ratio. When the MTI goes below a level of 0.60 and the buy to sell ratio goes below a level of 0.20, we feel that the market is extremely oversold. Okay, we feel this way because historically, when those indicators got to below those levels, there wasn't much downside. There wasn't much further downside. Now there could still be. When the indicators get to below those levels, the market can continue to fall. Okay, what we do is we wait for a rally. We wait for a market rally, an explosive market rally, and those are the type of rallies you generally see off of these types of major market bottoms. And December 26th, to be exact, the day after Christmas, we got a major rally. See this big unfilled green candle here? The VBC formed what's called a one white soldier. It's a bullish candlestick reversal pattern. We got follow through the next day. So that was the extreme oversold market situation that we were able to take advantage of just a few days off of the actual low. And it's really because of a couple of things. The MTI and the buy to sell ratio being below those levels, so we know that we're alert. We're ready for a rally. The rally happened. It formed a reversal signal, very, very reliable candlestick reversal pattern. We got followed through the next day, so there was our signal. Okay? Does that make sense to everybody? Is everybody a little bit clearer now on, okay, look, the market doesn't just trend, right? That would be awesome, but it doesn't. It doesn't just trend. Are you a little bit more clear on the different types of market environments that you're going to encounter and how to recognize them? Okay, Kumar says yes. I got one yes so far. John says yes. Bill says yes. Okay, good. So, and that's really important, guys. This first segment was really important. You have to understand what the market's doing because not all technical indicators work as well in all different types of market situations. So what we're going to focus on today is using the MACD in a trending market environment. The MACD stands for Moving Average Convergence Divergence. It has the words moving average in it. If you know about moving averages, you know that they are trend indicators, right? They work best in a trending market environment. Okay, so we are going to focus on using the MACD when the market's trending. It just makes sense. When the market's no longer trending and it's moving sideways, not hitting higher highs anymore, not hitting lower lows, we're going to use support and resistance to help us find stocks. So for example, if the market is retracing from a support level, the market support level, the VVC support level, that's a buying opportunity for a trader. We're going to look for stocks that are also retracing from their own support level. Okay? And then finally, when the MTI gets to below 0.6, the buy to sell ratio goes below 0.2, and then a rally occurs. Remember, we're not just buying stocks when those indicators are below those levels. Okay? We wait for a rally. When the rally occurs, a good indicator to use, one of my favorite indicators is the Stochastic Oscillator. It identifies oversold price situations. Okay? So when the market's oversold, we're going to look for stocks that are really beaten down and oversold. Those are the type of stocks that really snap back the strongest when the market does rally. Okay, so let's take a look at an example. Here's Netflix. Again, don't worry about the time frame. I went back to 2017. Again, it's the technique here that I want you guys to understand. Don't worry about the time frame. So, back in April of 2017, we got a buy signal. Really easy indicator to interpret. When the MACD histogram bars go from below 0 to above 0, that is a buying opportunity. Okay, histogram bars, these yellow bars go from below 0 to above 0, that is a buying opportunity. The selling opportunity is when the histogram bars go from above 0 to below 0. Okay, and you can just take a look at any stock on a chart and plot the MACD at the bottom. Yeah, I'm looking at 2017, basically. 2017. Again, don't worry about the time frame. It's the technique that's really important for you to understand. So buy signal here indicates a meaningful change in trend. Okay, a meaningful change in trend. Sell signal would have been right up in this area. Again, new high. So now what type of an environment are you in here? We're in an uptrending stock, right? The stock is hitting higher highs. It's also hitting higher lows. It's pulling back. We don't buy during the pullback. We don't even necessarily stay in the trade during the pullback because our MACD signal turned bearish about a week or so off of the high. You could see the MACD histogram bars stayed negative the entire time there. Reverse course, went positive. There's your buying opportunity. Another new high has been set in. So you're in an uptrending stock. So in an uptrending environment, in an uptrending stock market environment, in an uptrending stock, the MACD works really well. Okay. Now, not every trade you place is going to be a winner. I'm sure you all understand that. So for example, here we entered on a bullish MACD crossover. We exited on a bearish MACD crossover. Maybe that was a little losing trade. Maybe it was a wash. Now, what I don't want you to do is I don't want you to stay in the trade because you think it's going to go higher. Because in this case, if you would have stayed in and not exited when the signal told you to exit, you would have rode that baby down and not known what to do. That's a question I get a lot. Maybe it's a question you ask yourself. What do I do now? Right? I'm in this trade. I bought XYZ stock at this price. What do I do now? Okay. Is anybody else having trouble hearing me, by the way? Let me know. One person says there's no audio, probably because the speakers aren't turned on or working. Can everybody else hear me okay? Just type in the chat box that you can. Everybody hears me great. Okay, unfortunately there's just one person might not have their speakers turned on. Great. Okay. So you don't want to not follow the signal, because you're going to get in yourself a situation where you thought it was going to continue to go up, but it didn't, and you're digging yourself too deep into a hole, and you're wondering what to do. Okay? There are going to be buying opportunities again. So just continue to move, from left to right here. Nice. Look, we're still uptrending, right? Higher highs and higher lows. Now, this trade, unfortunately, wouldn't have been a winning trade. We got in, and look, we're a couple of weeks off of the low, right? Remember, the MACD is not it's not an oscillator. It's not like stochastics. MACD requires a meaningful change in trend for it to produce a signal. It's not going to get you in a day or two off of the low. Okay, that's not what the MACD is for. It's a trend indicator. We need a change in trend for the signal to be generated. Okay, you're always going to get an opportunity to get back in. Now what happens? Now we're not in a trending environment anymore, are we? Well, we are, but we're in a downtrend. We're in a downtrend. So remember what I said about being bullish only in an uptrend, in an uptrending market. Well, let's flip that over. You want to be bearish only, okay, in a downtrending market. Okay? You want to be bearish only in a downtrending market, meaning you don't want to buy even though you get a bullish signal. We got a bullish signal, right? November 6th of 2018, MACD histogram bars turned positive. We got a bullish signal. But are we in an uptrend? No, we're in a downtrend. Lower lows, lower highs. Why am I saying you don't want to buy even though we have a bullish MACD crossover in a downtrending market? The rallies in a downtrending market are pretty short-lived, right? They're, otherwise known as dead cat bounces, right? Rallies in a downtrend are short-lived. We don't want to play that. We're trying to put the probability on our side, right? And you're not doing that if you're buying in a downtrending market, even though you get a bullish MACD signal. Look, eventually you'll catch the bottom. That's not what we're trying to do, though. We're not just trying to, swing and miss, swing and miss, swing and miss until we finally hit the home run. There are times for that. I don't mind being a little speculative at times, given the situation, if the situation is right. But I don't do that with the majority of my trading. I'm not speculative. I'm aggressive. I use indicators. I don't mind getting in off of reversals, but there are certain times. So I know here you're saying, well, if I would have bought here, that would have been a good one. But what happened along the way is you accrued loss after loss after loss by trying to play the rallies in that downtrend. Okay, we don't want to do that. Okay, so trending market. How do we know it's a trending market? Higher highs and higher lows. Okay. Best indicator to use, in my opinion, is the MACD in that type of market environment. Next, when the market's not trending anymore and it's channeling, right, or trading sideways, we're going to focus on using an indicator called support and resistance, a very popular trading technique. One of the great things about the VectorVest tool is it has a way to automatically draw the support and resistance lines on the graph for you. So let's take a look at what I'm talking about. Before we get too deep, what is support and resistance? Basically, a support level is a point where stock prices have stopped going down and they begin to go back up. Typically, that happens on multiple occasions. It's where demand is deemed strong enough to push the price higher, to support it from falling any further. Resistance is a point where stock prices have stopped going up and they begin to come back down. Again, typically that happens multiple times. It's where supply is deemed strong enough to push the price lower. And support and resistance is the ultimate crowd mentality indicator. Think about it in terms of this. Okay? You buy a stock, right? You watch it go up. You buy it, you watch it go up, but you don't sell it. Why don't you sell it? Because you think it's going to continue to go up. Then what happens? Comes crashing down, right? What do you say to yourself? You say, whew, all right, I weathered that storm, but if it ever gets back up there again, I'll sell it this time, right? Then what happens? Price eventually reaches that level again, and then you and everybody else who bought it somewhere back here the first time, then you sell it. What does that do? Puts tremendous pressure on the stock's price, and it begins to fall. So how do you use support and resistance in your trading? Whoops. There are two buying opportunities or two bullish situations, and there are two bearish situations. Okay? Bullish situation number one is if you see price hitting support and then retracing from it. Hitting support and then retracing from it. Hitting support and then retracing from it. Not just falling to support. You want a retracement. You want to bounce off of that support level. That's a buying opportunity. Okay? The other buying opportunity is when price breaks out through resistance. Remember, we already said that there was built-in selling pressure, right, at those resistant zones based on the crowd mentality. Well, if a stock's price is able to overcome that selling pressure and bust through that resistance level, particularly on high volume, that's very bullish. That's a good indication to go long that position. There are two bearish situations. Okay, so you can use support and resistance to indicate when to sell an existing position, existing long position, or to initiate a short position. So bearish situation number one is if you see price hitting resistance and coming back down. Hitting resistance and coming back down. That's a bearish signal. Typically, it's going to continue to fall to at least the next support level. So if it's a trade that you're in, you should consider selling it or taking other defensive actions when you see price retracing from resistance. If you don't own the stock, it would indicate a possible shorting opportunity. Additionally, and you don't see this on the chart, but if you see price breaking down through a support level, right? So the support is the floor. If it breaks down below through the floor and continues to move lower, that's a bearish indication. If you're still long a trade and price breaks down through support, you should consider selling it. If you're not long the trade, you might want to consider taking the position short if you short stocks. Okay. And then finally, the other indicator that we'll talk about is stochastics, my favorite indicator. I use stochastics almost exclusively with bullish and bearish candlestick reversal patterns. So I like to look for situations when the stochastics oscillator is below 20. So stochastics is an oscillator. It oscillates above and below, in between 0 and 100. Below 20 is considered oversold. Above 80 is considered overbought. We're only going to focus on the oversold situations here today. Okay? And I like to use stochastics when the stochastics oscillator is below 20. I like to look for a bullish reversal pattern, a bullish candlestick reversal pattern, maybe a harami or an engulfing pattern or a hammer or a one white soldier or a piercing pattern, any type of 1 or 2, maybe 3 bar candlestick reversal signal when the stochastic oscillator is below 20. That's kind of my go-to setup there. Really love this indicator. Now, don't let all the squiggly lines confuse you. It's not confusing. Let's just take a look at an example. We're looking at Abbott Labs. Would you agree that when the stochastic oscillator goes below 20, we're somewhere near a good buying opportunity? Right? Somewhere near a good buying opportunity. Yeah, and Abbott Labs actually is an uptrending stock. So you can use stochastics, guys, in honestly any type of market. Let me say this. Don't use MACD in any other type of market other than a trending market. You can mix and match using stochastics really anywhere. You know, you're probably looking at this and say, well, if you're telling me that stochastics identifies oversold situations, and you look at price here and you say, well, that doesn't look oversold to me, or this doesn't really look oversold to me, or this here doesn't. Well, maybe it doesn't with the naked eye, but that's what indicators are for. They're to help us make better sense of price in a way where we can't with the naked eye. So even though we think that this is not an oversold situation, stochastics is telling us that it is. So a short-term oversold situation in an underlying uptrend, that's a beautiful trading opportunity. Okay? So the buying opportunity, though, doesn't come just when the stochastics oscillator is below 20. We wait for the indicator to cross from below 20 to above 20. That's our buy signal, crossing from below 20 to above 20. And remember I said earlier with the MACD, you know, how it requires a meaningful change in trend in order for a signal to be given? It's not the case with stochastics, right? When would the MACD have gotten us into Abbott Labs off of this higher low here? Maybe somewhere in this area, right? Maybe in this case, maybe somewhere in this area, not 2 days off of the actual low. Stochastics does a really good job of doing that. Okay, getting us in early off of an extremely oversold situation. So here, really good setup here. I really wanted to show you guys this setup. So the market, the stock obviously uptrend, right? Then crashed. That, just looking at the stock's price, that you would consider and recognize that that's an oversold situation, right? That's a really violent crash. Didn't take very long to get there. All of the gains over maybe a couple of months were given back in a few weeks. But the stochastics oscillator went below 20, all right? So we're going to look for a signal. Stochastics oscillators, we're looking at industry standard, so it's 14.3 slow. 14.3 slow stochastics, okay? So a couple of days prior to my date line here was a bullish candlestick reversal pattern, similar to what I referenced earlier. This is called a bullish harami. Very, very reliable reversal signal. We got follow through the next day. Price began to rise off of the low. The stochastics oscillator went from below 20 to above 20. There's your trade. Okay? There's your entry. Now I'm big, if you haven't noticed yet, I'm big on candlestick analysis. So I'm in a trade here off of this higher low. Stochastics goes from below 20 to above 20. I like to set a profit target at the most recent swing high. And that would be here. And that's just not your run-of-the-mill swing high, right? Look at those long upper wicks there. So those long upper wicks tell me that the uptrend here was weakening considerably on those days. Now I know that those are green candles, but look at where the closes were compared to the highs, right? Well off of the highs, really close to the lows, creating these long upper wicks on the candlesticks. That's not bullish. That has potential bearish implications. You could see party was over, right? Stock crashed for a couple of weeks there and eventually settled in, and we got a good buying opportunity. But it's that area again where I'm going to consider taking gains off the table. Price got there. I hope it breaks through, right? But it didn't. It reached that level and then retraced from it. So what is that now? What is being created here? With the stock price failing to make a new high and then sharply retracing from the same level, what is that creating? That's creating a level of resistance, right? Okay, so what did we say to do with a trade if price retraces from resistance? We said to either consider selling it or taking other defensive action. So you did that. You sell the whole position, you tighten up your stops at the very least, and then you're out of the trade at a really good gain. Let's see when our next entry would be. So here, beginning of April of 2018, stochastics goes below 20. Right? We don't just enter because it goes below 20. We wait for it to cross above 20, and that happened. The stock price fell. Basically, it stopped at the same level that it stopped back here, right? It didn't make a new low. Basically stopped at the same level. So we get in the trade off of that retracement, and then what happens the very next day? The stock crashes, right? And I don't know if you've done this in the past, but in a situation like that where the very next day that you get into a trade, it crashes and you sell. That's otherwise maybe known as panic selling, right? You're only in the trade a day, and it does go down the following day. But let's be a little bit smarter and more aware of the current situation before just unloading the position because it goes down the next day. And what I mean by that is we have this level here now that price is establishing at support. So even though price crashed the next day, it didn't fall to a new low, right? Didn't fall to a new low, kind of stopped again at the same level that it stopped back here. So let's not panic and get rid of a trade just because it goes down big one day. Let's look at the chart and see, all right, is price falling to a support level? And if it is, let me wait a bit. Let me wait to see if price breaks down through that support level. And it didn't, right? It retraced from it. And even though it got up here, you're still not profitable because you entered right on that that doji day the next day. So you're still not profitable, but you think you're in the clear. And then what happens? Another retest. Price falls again and retests that same support level that it did prior. You don't panic. You say, all right, this trade hasn't gotten off on to the start that I was hoping for, but let's be patient. The stock price retraces. See that long lower wick? Remember I said that the long upper wicks that's not bullish, right? In an uptrend. Well, long lower wicks in a downtrend, that is bullish. Because look at how far price closed that day off of the low. We got followed through the next day, and then you were off and running. So you weathered a couple of storms here, but you recognize that, look, there was a support level. There's a floor that I got to pay attention to before I just go out and sell the stock because it goes down a couple of days. Okay? We're not in a downtrend. How do I know we're not in a downtrend? Because we're not hitting lower lows. We're not in an uptrend anymore either. So the uptrend is over, and now we're just moving sideways because now price rallies to the same level that it did back in March of 18, and then it retraces again. So now we're just kind of moving sideways here. Okay, so this retracement, if you hadn't sold a position yet, this retracement off of resistance is your exit there from this trade that you placed all the way back here. Price falls. It doesn't fall all the way to support again, but it falls enough where stochastics goes below 20, crosses from below 20 to above 20, gives you a good opportunity to get back in. You bought low, you sold high, you're trying to buy low again. So you buy back in, and that resistance level doesn't just go away. It's still there. We have to pay attention to it. And what happens? Price reaches that resistance level again. You see that big red candle? That's a resistance retracement, in my opinion, right? And then I would get out of the trade. I'm not going to sit here and tell you that I would have stayed in all the way through because that looks better and sounds better. That's not the case. That's a support. That's a resistance retracement. I'm exiting the trade and taking my gains. And I know what price did afterwards. It just busted through resistance, and you missed out on some gains, but you made some and you took profits. So price breaks out through resistance. That resistance level then becomes support. A lot of times, what you'll see is when price breaks out through a resistance level, it'll come back to retest that same zone, which again is now support since price is above it. So what did it do? Came back down, retested support, retraced. Retested support again. That retest coincided with stochastics going from below 20 to above 20. There was a nice re-entry back in. And now you're back in an uptrend, right? Now we're breaking through, we're hitting higher highs and higher lows, but now we get into a situation where we're moving sideways once again. Okay? Establishing support. Buying off of support. Okay? Not selling because the stock, buying off of a support retracement, but not just selling because the stock price goes down 2 days. And that, look, I know it's easier said than done, but it takes practice, and it takes real life trading. Doesn't have to be with a lot of money, but know what it feels like to buy a stock and have it go down a couple of days pretty significantly, but not sell it because you understand that there is a pretty significant support level here. 1 touch, 2 touches, 3 touches right in this zone. So all right, look, I'm down a little bit on the position. Stock's gone down quite a bit, but I'll sell it, if it ever breaks down through that support level. It never did. Okay? It never did. It retraced from it, so it wound up being a winning trade. All right? So the next part, or the final piece to our triangle here, is how are we now going to find our trades? Okay? We understand what the market's doing. I hope you guys do a little bit better now, right? Or what it can do. It can trend. And when we recognize a trending market by higher highs and higher lows. If it doesn't hit higher highs, but it doesn't hit lower lows, it moves sideways, you're in a channeling market. Support and resistance, really good indicator in that type of environment. And then if the MTI goes below 0.60, the buy to sell ratio goes below 0.20, we are in a really oversold market situation. And the ideal indicator would be the stochastic oscillator. So how are we going to find our trades? Well, there's 3 methods. Number 1 is the 1-by-1 method. This is the method where you look at charts. It could be hundreds of charts in a day. So for example, if you want to, if the market's trending, right? If it's trending higher, you want to look for MACD crossovers, right? The histogram bar is going from below 0 to above 0. Well, you'd look at the chart. Go through the stock, put the MACD on the bottom. If you don't see, as of the hard right edge, as of the most recent time, if you don't see the MACD crossing from below 0 to above 0 on that day, that's not a trade that you would place. So you'd go to the next one, and so on and so forth until you're comfortable with a handful of stocks, or a handful of stocks. Okay. My preferred method, and I told you guys I like to look at charts, but my preferred method is to use a scan first. A scan that filters through the thousands of stocks that we track to find all stocks whose MACD just crossed positive today, whose histogram first crossed from below 0 to above 0 on the day. Okay? And then I'll go through the charts and just kind of cherry pick some of my favorite ones based on, a smoother price action. I don't want a ton of volatility. I want to make sure that the stock is trending, right? Because just because you run a scan looking for a MACD crossover doesn't mean that over the last, let's say, 6 months or so, the stock's been trending nicely, right? Was trending nicely, just recently pulled back from a new high. Stochastics went, MACD goes from above zero to below zero, and then you get a reversal. A new high is put in, a new low is put in, a higher low is put in. MACD goes from below zero to above zero. That's what the scan is going to find, but you got to look at the chart. Okay, and that's the next step after running the scan. So that's a much faster way as opposed to starting with just looking at chart after chart. Then finally, there's a tool within our real-time program called the Watchdog. This is an automatic alerting system. Okay, so let's go through just briefly, kind of give you an example of each method. So the one-by-one method, you'd use a list of stocks. Maybe it's a watch list that you've created, or you can go into the VectorVest watch list and maybe look at the S&P 500. Okay, and look at the charts. Remember, before we zero in on an indicator that we're going to use, we got to recognize what the market's doing first. So in another example, let's say the market, the VVC, is retracing from support. Maybe it's bouncing off a support level that it's done so for twice or three times in the past. So the market's channeling, bouncing off of support, and you go looking at stocks using the one-by-one method. You put on support and resistance, and you look for price retracing from support. You can go through a lot of stocks that way using the one-by-one method, and maybe not find a good handful that you can even consider trading. This is my preferred method. Within the real-time program, or VectorVest Premium, we have a tool called Pro Trader. This is a technical analysis scanning tool. You can scan for, among other things, MACD crossovers, stochastics crossovers, and all four of the support and resistance situations that we talked about. Retracing from support, retracing from resistance, breaking support or breaking resistance. Within this folder in Unisearch, again, within the Pro Trader tool, you can look for other things like moving average crossovers, or RSI, or DPO, ADX. There's a lot of different technical indicators that you could scan for. Okay, and then finally, within the VectorVest Premium real-time program, we have a tool called the Watchdog. I like this tool. It allows me to set up a filter or a scan once, and I don't have to. With the Unisearch Pro Trader, you have to click a few buttons to run the scan. You got to do that every day. With the Watchdog, you don't. You just set it up once, and it runs and scans the database all throughout the day, every day for you. So in this situation, I have one, it's called MACD Bullish S&P 500. Just simply looking at stocks in the S&P 500, above $5, with an average volume greater than 250,000 shares that have a bullish MACD crossover. So that crossover can occur during the day, and it will send me an email and or a text message when stocks in the S&P 500 have a bullish MACD crossover. But I have to remember that I'm only going to favor these stocks and focus on these stocks if the market is trending higher. Okay? So I'm going to take a few guesses as to why you guys showed up today. Are you missing out on the current market? Boy, I hope not. I know the market's pulled back a little bit over the last couple of days. What is it doing today? Tough day today. We thought we'd get a nice rally. Not so much today. But maybe you're missing out on the current market. Okay? Your current trading plan isn't performing like you want it to. And maybe you're here because you wanted a better, faster way to find trades. Maybe you're doing it the one-by-one method, and you're just fed up. It's just taking you too long. There are faster ways to find trading opportunities, and the same trading opportunities that you can, that you can find manually. But there are some faster ways. So today you learned to match the market to your indicator. I'm going to flip that around. You learned to match the indicator to the market, right? Because we're looking at the market first, then basing our decision making on the market, as opposed to we're going to look at the indicator and then what is the market doing. You also learn how to effectively use popular technical indicators, and I didn't throw a dozen at you. I taught you guys how to use 3 indicators, one for each of the 3 different types of market environments that you'll face, and then how to quickly and easily find trading opportunities, especially if you use the power of speed. So the big lesson is that technical analysis can help anticipate future direction, and you can find some great trading opportunities, again, especially if you use the power of speed. So you might be wondering, you might be saying, well, how can I get started using technical analysis? I've always been interested. This is what I'm here for. I really want to start using technical analysis to kind of supercharge my portfolio. You can really make some explosive returns in a very short period of time. Now you have a choice. You can do it the slow way. That's taking a little bit of what I taught you here today and doing it the one-by-one method, or you can do it the fast way. So the one-by-one method, again, you throw up a chart, you look at the MACD. Is there a crossover? Is there a support retracement? Is stochastics going from below 20 to above 20? That's going to be done on a large list of stocks, and maybe you'll come out with a few at the very end. Using our Pro Trader searches, which is again included in the VectorVest Premium real-time product, you get to scan for moving average crossovers, support retracements, MACD, stochastics, things like that. That gets you to a handful of candidates, of potential candidates, a lot faster. And then within the VectorVest Premium program, we have a tool called the Watchdog. This is an automatic alerting system. It allows you to set it up once, and then all throughout the day, it will scan the database or a watch list of stocks. You can choose a watch list if you don't want to scan the whole database. Okay. He's asking, what do I think about penny stocks? Depends on depends on the situation. Depends on the industry that it's in. But not a big penny stock guy, to be honest with you. I'm not a big penny stock trader. There's a time for it, and I wouldn't mind throwing a few bucks at a penny stock, but I'm not doing the majority of my trading on penny stocks. Again, if the situation's right, if the sector is hot, you got a lower dollar stock that is very likely to come along for the ride. That might be an opportunity, but that's not what we're trying to do here. Okay, so here's a recap. Within the VectorVest real-time program, also known as VectorVest Premium, you get fundamental and technical charting. We give you guys market timing signals for clear entries, those Pro Trader searches, which are the technical analysis scans, the Watchdog, which gives you instant alerts, the Genius, one of my favorite tools because it's an automated portfolio manager, which also gives you alerts as well, and pre-built trading systems. And of course, real-time streaming data. Now, normally we would sell this, not normally, we do sell this whole package for $137 per month. What I want to do is say thank you, number one, for taking time out of your day to join me here today. But I'm going to give you guys an opportunity, if you don't already have the VectorVest real-time premium package, to try it out for 30 days, $9.95. If you're a VectorVest subscriber who has the end-of-day product or the intraday version, this is a trial for you. If you already have real time, you probably love it, right? So unfortunately, we don't have a trial for anybody who has the VectorVest real-time program. However, what I want to do for you folks is, if you are already a VectorVest real-time program subscriber, send me an email at jerryd, Jerryd, D as in David, at VectorVest.com, and I'm going to send you this checklist. This is a stock buying checklist that's going to be given to anyone that takes out the trial. Okay, you see the website at the bottom, www.vectorvest.com/capture-trades. www.vectorvest.com/capture-trades. By the way, this is money back guaranteed. If at the end of 30 days you say, you know what, this is not for me, I don't need the real-time program, I'll go back to my end-of-day version or the intraday version, no problem, we'll give you the $9.95 back. So nothing really to lose but to try the real-time program, the VectorVest Premium program, for 30 days. Okay, so I want to thank you guys for joining me here today. The website to go to is www.vectorvest.com. capture trades. This is good for this $9.95 offer is good until Monday at 5 p.m. It will expire then, so you have the weekend to think about it. This webinar is also being recorded, so you will get the recording sometime later tonight. But again, my email address is jerryd, Jerry, D as in David, at VectorVest.com. If you have any questions whatsoever about anything that I talked about here today, just shoot me an email and say, hey, Jerry, I was on your 3 techniques webinar. I had a question that maybe you weren't able to answer. Okay. All right, folks. Well, you guys have a great weekend. Enjoy the rest of your day, and happy trading, everybody. Take care, folks.